Have you ever just looked at your investment portfolio and thought, holy shit, this got out of hand? You see, that is something that happened to me and why I put out my recent video on why I'm selling a whole bunch of my different stocks. And in this video, I'm actually going to be buying and structuring out this portfolio in front of all of you. Now, the reason why it got to this point is I was really focused on the stock market for a very long time, talking about it on my channel, making investments that I really did love at the time. And then what ended up happening was I bought a real estate property, had to do a bunch of renovation. It took all of my time away from focusing on the stock market when I should have restructured those funds into exchange traded funds. I should have just moved the investments from those individual stocks. That way it would have continued growing with the market, and I wouldn't have looked back and had worse returns than what we're seeing from the overall market. But that's not something I thought about at the time. Hindsight's 2020. I would totally do that now next time this happens to me. But for now, I'm back. I'm back, baby. I can start making the investments that I want to make. I can start focusing on this portfolio again and hopefully continue beating the stock market as I was before. Now, I'm going to be sharing a whole bunch of insight in this video. I'm going to be sharing every investment that I've made, all the different tweaks that I've made to these portfolios, and I'm going to share with you how you can follow along and get updates in real time with what's going on. So without further ado, let's jump in. All right, so the first account that I want to cover in the moves that I've recently been making, I transferred my Roth IRA into Robinhood investing. I took advantage of the 3% match, made about $400 free money in doing so. And then in that, I also put the rest of the money that I could contribute for 2024 into this account. Now, it's not all invested, and here's my thinking behind that. The stock market right now, if you go into something like VTI and you look at the max return from it, we're at pretty much all-time highs. So I have about $5,000 in buying power in this account that I haven't quite invested yet. And I think spacing them out, either weekly or monthly for the rest of the year makes sense, only because if the stock market starts to tank, I can capitalize on buying in at lower prices. If the stock market skyrockets, I'm just going to continue buying as it goes up. And either way, I'm going to be getting some returns off of that in the future. And VTI, again, it traces the market. Really solid investment. This is the basis of everything. And currently I have $8,818 invested in it. The other investment in my Roth IRA is SCHD. SCHD is a really, really solid Schwab US dividend equity ETF. Now, there's some very solid dividend paying stocks in here. And what happens is, as I'm paid the dividend from SCHD, this is then going to be reinvested into this portfolio. It's just going to continue growing over time, get that dividend snowball rolling, and it's just pretty exciting to see. Now, listen, before I jump into this individual portfolio, I want to talk about something I launched last week. It's called Common Sense with Dalton. You can head over to my website, sign up for the newsletter. In this newsletter, what you're going to receive is notifications of the buys and sells that I'm making with my investments on a weekly basis. You're going to get an inside look into something like my net worth tracker, and then also like just general financial tips, principles, things that I'm working on to sort of fuel myself towards financial freedom. And I think it's going to be really great because you can take these actionable steps. We can build together. And much like I'm planning on doing with this portfolio and showcasing everything here on the channel, I think it just helps in that we're going to be on this journey together. And I think that we can all achieve financial freedom to some degree. So head on over to the website, sign up, and get that first email in your inbox. Now, the main approach when I started rebuilding this portfolio was to diversify my funds. Now, my investments are in different industries such as technology, communication services, energy, healthcare, consumer defensive, consumer cyclical, financial services, as well as real estate. So I tried to target what I thought were some of the best stocks in each one of those categories to kick off this portfolio. Now, the very first one I said was technology, and I went with Microsoft and Apple. You ask any other investor, it's likely to be in their portfolio, two of the highest performing investments that I've made over time. And I think that you really can't go wrong with these two investments. So with Microsoft, you got a bunch of cloud computing going on, the AI stuff that's taking place. I think there's tons of potential for them in the future. And then Apple, which could capitalize on a lot of the same stuff, but on top of that, building the products that they have. I mean, I'm a huge Apple advocate. You can see the laptop here, got the iPad here, cell phones. But on top of that, things like the Apple Vision Pro, if that catches on and continues to grow and they continue to innovate in that area, I think that they're going to be a dominant player in there, and just the financials are going to back that. When you look at telecommunication companies, you typically think of the big players being AT&T and Verizon, but I tend to look at companies like Comcast. Comcast has done a fantastic job building out their Xfinity mobile branch of the business. They bought it back in 2017. It had 1.275 million users shareholders. And now fast forward to today, they have over 6.59 million. Now what this equates to in revenue is starting with 593 million back in 2017. Today it generates over $3.66 billion. Now on top of that, they've done a great job with their team in building out different revenue streams. And they actually have a fantastic track record with their broadband internet service that they typically target for businesses. And they actually lost just a tiny bit of their customer base last year. However, their revenue continued to increase through price increases that they had, and things are still looking up for that. It'll be interesting to see what happens for the customer base, but the way that management has been handling the situation, and I think that the other income streams that they're working on building out, there's just a lot of potential to have this in a portfolio. When you look at the energy sector, I like Chevron. Chevron is an extremely profitable business. Now, one thing is, if you're more into eco investing, Chevron doesn't really reinvest too much back into clean energy. I think they're like a $280 billion company. And of that, about $10 billion gets allocated into, renewable energy. So it'll be interesting to see how that kind of trends in the future. But if you can get past that, super profitable, and then they redistribute their earnings back to shareholders. I think their dividend yield is like 3.93%. So if you're into dividend income, it's a very solid investment. That's one of the reasons why I love it too, and just definitely added that into my portfolio. So when I looked at healthcare and pharmaceuticals, I came across AbbVie, and I realized that last year they dropped about 6%. Their earnings per share went drastically down. And the reason being is they had a drug called Humira, and this is used typically to treat arthritic patients. And what happened was that patent went away. So you'd think that their revenue would go down, and it was actually quoted as the highest grossing drug on the market. So it was interesting that their revenue actually continued to increase. And so we've seen a little bit of a bounce back in terms of what their share price is. They're up about 13 or 14% if you look at the year to date. And so I think there's some more room to grow, especially with the drugs and the research that they have out there right now. And then again, like another dividend player that's going to help foster more growth in your portfolio. So I think like this is one that I definitely wanted to take advantage of at the current place. And I think there's some potential growth here. Now, when I'm looking at consumer defensive stocks, I like things that are kind of pretty stable and they will not be affected too much by market conditions. And I look at companies like, Coca-Cola is Warren Buffett's favorite one to invest in. I myself am picking up some Pepsi. The reason why I went with Pepsi is they've been making pretty good headlines lately. They're replacing Subway's main drink provider. They're replacing Coca-Cola with Pepsi in 2025. I think that's a really good move for Pepsi there. I'm going to be able to capitalize on more revenue. With something like Pepsi, you're not going to see any of these crazy returns, but I think the next, year, you could see something that's pretty decent from it. But I also could see this being a play where I'm going to end up selling out of not too far down the line. It was just one that I thought there was an opportunity to jump in, and I want to see where this one takes me. So my investment into the financial services industry was made through Visa. And this one is kind of interesting because you're catching it on the way up. Visa in the last decade is up 171%. And they're actually projected to continue growing at 10% annually. On top of that, they offer a dividend yield, though it's not anything too crazy. It's usually hard to find some solid stocks that have growth like this that offer some type of yield. Now for real estate, I'm going for a value and dividend play here, and this is an interesting one. Now a lot of people know Realty Income as the monthly dividend paying company. They love it because they're getting that stable income, but I actually think it's poised for some growth. We're at the best buy-in price point in the past 5 years if you look at the chart. And I think that, looking at the dividend yield, it's now 5.89%. The rolling average on this is about 4.54%. So it's really interesting to see that you're going to get some solid, consistent income. The way Realty Income works is that it's triple net leases. So the people that are like tenants of the properties, they handle all the repairs, the maintenance, things like that. So there's not really a ton of overhead when it comes to this stuff. And with this company being a REIT, they're required to pay about 90% of the earnings back to shareholders. So I think there's an opportunity where we're going to see the value of this go up, and then you're going to be collecting some consistent income you can reinvest along the way. So that's just one thing that I'm looking at there. Okay, so real quickly, I want to show you a snapshot of everything in this portfolio. This is the Excel spreadsheet that I have for my investment portfolio tracker. You're probably going to come to know and love this. This is going to be used in a lot of future videos. It's going to be used in the email newsletter as well. And there's a couple stocks that I didn't mention on this list. We got Johnson & Johnson, we've got Home Depot, and then Meta. Meta was a really cool one where I bought in at $97 a share. I'm up like 400% on that one individual share that I own. Kind of crazy to see. In the far right column, I just wanted to point out the total percentage of the portfolio. Now, again, a majority of this is in VTI, SCHD, the largest chunk of this portfolio. The rest is just kind of spaced out. And I think that's going to continue. Obviously, I got another $5,000 going into those two funds. And then I'm just going to be investing over time into the other stocks here, and then potentially adding some in the future, potentially removing some of these. We'll have a bunch of updates on everything that goes on. If you take a quick look at the dashboard, we got the overall stats from this investment account. And then what I wanted to do next is just back test this and see how this portfolio would have compared against the overall stock market in the past number of years. Okay, so you can see that now I'm on portfoliovisualizer.com where we can back test this. I'm going to compare how it's done over the past 10 years. We can see that this is the whole list of stocks that I just mentioned. I left off a couple like Meta just because, they weren't really part of this portfolio. And then I'm comparing it to SPY. So you can scroll down, you can see the asset allocation to each one. And then as you look at the results, you're going to see that portfolio one, the one we just created, would have been about, roughly $18,000 higher than what the S&P 500 would have returned here. The best year it would have returned 33.61%, and the worst year it would have only gone down 2%. Now that's what I'm talking about with this particular portfolio. If we have, a negative market, it might not drop as far as some of these other ones, whereas the worst year for the S&P was down 18% here in this chart. Now you can see over time like what this kind of turned into and how it grew, and the annual returns from the portfolio. Now let me know what you guys think. Did I miss any particular investments that you think should be on this list? I'm curious what picks you guys have. Now this is going to be quite interesting to follow along with the series. Head over to the website and get all those updates that I was talking about before. Thank you for checking out the video, and have a great day.